All right, guys, here we go. In this video, we're going to cover some information. There's a lot of people out there, big influencers comparing the current market and state of the economy to that of the 2007, 2008 real estate bubble crash, market, bubble crash, et cetera, et cetera. So we're going to back up and take a look at history, take a look at the facts, and honestly, take a look at the charts. And bottom line, if you're comparing the current housing market in 2008, then we should see actually a rally starting in January up through the first quarter of this year. So basically, to confirm that, we need to break out on this little pennant formation here on the XHB, basically the spider or the home builders ETF. And we'll get more into this chart here in a little bit. But anyway, we should see a breakout and a run up starting about the end of the month. And then the market should roll over and then start to quote unquote crash starting the second into the third quarter of 2023. And then speaking of crashing, markets never crash overnight. They never, unless there's some sort of a black swan anomaly event, markets always show you before it happens what's going to happen. Okay. And let me give you two quick examples on this XHB chart here, the spider of the home builders. And as you can see, we have this long-term uptrend line here on the weekly chart, and high odds, high probability when an asset hits a support line. On the third time, it'll bounce, and then on the fourth or fifth, it'll break down through that previous support level. And as you can see here, we got both a close under the 20, this blue, if you can see it on this dark chart. Anyway, this blue simple week moving average, the 20, and then our long-term uptrend line, and then, the results. And from there, let's go over to the SPY, it's the ETF for the S&P 500, and even going back as far as 2019. We had the big COVID slam down. We were in this ascending wedge formation, which again, high odds, high probability they break to the downside, which is exactly what happened. We closed under the 20 here. Still had a lot of downdraft even after that. And then most recently, again, another little ascending wedge formation, dropped under it, closed a weekly candle under the 20, which generally notes gloom and doom, and then, high, lower high, lower high, lower high, the rest of the story. So let's go back to the home builder um, ETF, and then let's go from the start. Let's go back to the beginning and show even when this ETF first started out, before the housing market crashed, it gave evidence. There was sideways consolidation here. We were in an inside bar. In other words, everything closing inside this one weekly candle for 1, 2, 3, 4, 5, 6 weeks. And then as you can see, we broke down and under this inside bar candle. Then, the rest is history. We ended up coming down actually about 80% at the lows. Okay. And then in comparison to current day, now, there's, it's not going to trade tick for tick, the markets today to, back in, 2008. But if we're comparing, we need to compare. Okay. And as you can see, we bottomed here in January of 2008, made a little run up uh, to this, consolidation zone up here. Tried it again, and then finally, in May of 2008, started running down, made a lower one key that we were going to be weaker and weaker, is that we made a lower low here. Okay. Ran up, and guess what? High, lower high, and then the continuation to the downside. Okay. And then it took quite a while for home prices to get back up and running again. Now, obviously, there was money to be made down here, as once we hit this double bottom going back 2008, and then we hit it again 2009. It was pretty much an up market then, but it still took until where this blue arrow is, where we uh, crossed up and over on the weekly chart in 2012 to get back, to these little, run ups going back 2008. So, yeah, it took a little bit to get there. Now, let's talk about what happened back then. Well, first of all, let me show you this. From where it consolidated at when it first started out all-time highs. See, we hit it here, came back down in 2018, consolidated for quite a while here for a couple of months. 2020 got over. Of course, we had the big slam down. Then we finally got back up and over it, for this current run right here in July 2020. Okay, and we haven't come back and retested that. And speaking of that, this is both of these lines, the gold and the green dash lines, are very significant price levels, support levels. So that's where I would call the bottom, quite honestly. We'll definitely get, if we start dropping and get back up, back under the 200, this purple line and this uptrend line. And normally we should, bounce here if we come back down, get another little bounce. If we roll over, long story short, in the conversation, we're going to come down here and hopefully consolidate and then bounce from this area. Now, whenever, that might take, 3 months, 6 months, the whole year, who knows? But this is the call I'm making is that we're going to, if we are in a downtrend, a continued downtrend, a continued bear market, going into the spring. And, normally we're in a down trend market anyway during the fall and winter and housing, practically all over the country for obvious reasons. So, yeah, we're calling that when and if we get down here, that'd be pretty much the bottom, and then we'll pull out of there. Now, in talking just numbers now in comparison to current markets versus 2007 2008, we have a lot stricter lending practices. Of course, rising interest rates and high home prices currently should keep our demand in check. And what happened, back in 2000, well, really six, seven, eight, even going back as far as 2004, there were trillions of dollars poured into the market, what they called ninja loans, okay? Ninja mortgages, no income, no job, no assets. People were getting, second, third home mortgages, trying to get into the rental market, et cetera, et cetera. And well, each year, 2004, 2005, and six, there was over $1 trillion more coming into the mortgage market. Everybody and their brother was out there, forming these mortgage companies, lending money to, potential home buyers for their second, third homes with very little credit security and the ability to pay those mortgages back. Okay. And then at the same time, we had, newcomers coming into the mortgage market, these private label mortgage-backed securities, which was previous a very small niche, um, part of the market that expanded to more than 50% of the market at the peak in 2006. So that is not happening. So I believe personally, with the increased in interest rates, the very high prices of homes now, smart money is going to, sit on the sidelines until these things stable, kind of stable and pull back some, and then we'll see probably more people, stepping up into the housing market. And of course, yeah, people that bought within the last, couple of years, they're probably going to be upside down for a while. But as you can see, we always come back from it. Okay. We always, you know, prices, inflation, et cetera, uh, takes over, and then here we go again. And that's the one thing Wall Street, the blueprint of Wall Street, basically is very simple. They take an asset, whether it's tech, or the stock market, or housing, whatever the bubble of the year is, and they take that sector, take that asset, and run it up to the biggest bubble the world has ever seen. Of course, they dump out, the whole thing crashes, and then what happens? They start all over again. I mean, the U.S. has had several um, housing bubbles, even starting before the 1900s. In the 1800s, we had several housing bubbles, and that people don't realize. But anyway, yeah, and we keep repeating the same mistakes. Okay, it's like we can't learn from. The banks get out of control. Easy money, low interest rates, money flooding the market to be loaned out because of these big banks and mortgage companies and smaller, kind of, um, you know, cottage loan market out there, flooding the system with money and leading up, to present day. But anyway, hope that helps. And please comment below, and we will see you on the charts.